Afternoon, everyone. Thank you for standing by, and we're just going to kick off welcome, and we're just about to kick off the Perpetual Equity Investment Company half-year 2019 investor update presentation. Just a little bit of housekeeping before we get underway. Just letting everyone know that all participants are in a listen-only mode. For those who pre-registered for the presentation, you will have been emailed a copy of the slide pack this morning. During the presentation, both David and Vince will refer to these slides. For anyone who didn't receive a copy of the slides, they're available on the company's website in the ASX announcement section. Obviously, we'll run through the presentation with David and Vince. We'll allow questions at the conclusion. And just a reminder, if you wish to ask a question and you're on the phone, just press the star key, followed by the number 1. And also, if you're joining us today on the webcast, just hit the Ask a Question tab. Okay, so I'd now like to just hand over to David Lane, Group Executive of Perpetual Investments and Executive Director of the Perpetual Equity Investment Company. Thanks, David.
Hello, everyone, and thank you for joining us for an update on the Perpetual Equity Investment Company Limited, or PIC by its ASX code, as I'll reference throughout the presentation. My name is David Lane. I'm the Group Executive for Perpetual Investments and the Executive Director of Perpetual Equity Investment Company. And today I'm joined by Vince Pezzullo, who is the Portfolio Manager for PIC. As with all investments, there is important information that accompanies today's presentations, as you will see in slide 2. Turning to slide 3, you will see the agenda for today's presentation. I will be taking you through the company's 2019 half-year result highlights before handing over to Vince, who will then provide you with context on the current market conditions, investment performance, and how the portfolio is positioned. For those of you who might not be as familiar with the company, PIC was listed on the ASX in 2014 to help investors conveniently access a portfolio of high-quality Australian and global securities to provide regular income and long-term capital growth over a minimum 5-year investment period. The company leverages the resources of the entire Perpetual Investments Equities team, who have a proven track record of investing excellence with a focus on value and quality. The company's investment strategy is to hold an actively managed portfolio of quality securities. More specifically, up to 100% of our funds can be invested in Australian listed securities, typically with a mid-cap focus. However, up to 25% of the portfolio can be invested in global securities to allow us to take advantage of opportunities outside of Australia. 25% of the portfolio can also be held in cash to provide downside protection and flexibility to act on investment opportunities as they arise. As a guide, we hold 20 to 40 stocks in the portfolio. Please now turn to slide 6, which highlights the first half results announced by the company. First half fiscal year 19 marked another challenging period, with markets experiencing a broad sell-off both domestically and globally. Vince and his team continue to focus on strategically managing the portfolio and staying true to our disciplined investment approach to deliver sustainable income and capital growth for shareholders. The company has declared a fully franked interim dividend of 3.1 cents per share, which is a 3% increase on the first half of 2018. During a time of market volatility and overall market weakness, we have achieved this for our investors through prudent management of the company. Importantly for shareholders, the interim dividend will be paid on the 26th of April 2019. The fully franked interim dividend provides shareholders with an annual dividend yield of 6.1% and a gross dividend yield, taking franking credits into account, of 8.45%. The company remains focused on paying dividends to provide a yield which compares favorably to the Australian market dividend. Importantly, Vince has been strategically managing the portfolio to protect your franking credits. In anticipation of any potential legislative change, the board is also actively considering its response to facilitate investors receiving the benefits of accumulated franking credits. From a financial perspective, the company announced an operating loss after tax of $16.2 million for the 6 months ending 31 December 2018. The loss is largely a result of unrealized losses attributed to market weakness during the first half of 2019. However, subsequent improvements in market conditions have seen an upturn in this position. We would like to thank shareholders for their support during the capital raising and welcome our new shareholders. There was strong interest in the offer, raising the full amount of just in excess of $101 million. The money from the capital raising has now been fully invested. Volatility during the December quarter provided Vince with an excellent opportunity to deploy the additional capital into quality companies trading at attractive prices. When we started PIC, we set out to ensure our shareholders were kept well informed, recognizing investors seek transparency and regular access to portfolio manager insights. The PIC website now hosts several videos of Vince discussing the market themes and trends. You can also watch insight videos from a number of Perpetual's broader investment team, as well as access monthly reports including commentary on individual stock selections. We have also recently updated the monthly report to include a breakdown of portfolio sector holdings. You can also view the NTA daily and view the share price graph. For your convenience, you can also register to receive the monthly newsletter via email. If you haven't done so recently, I encourage you to take a look at the website. We will continue to enhance the tools and resources available to you, our shareholders, throughout fiscal year 19. Building a strong track record is crucial, and the company is committed to value investing. The experienced investment team take a bottom-up approach to investing and are true to label as value investors. The board remains confident this investment approach and philosophy will continue to serve shareholders well by sustainably growing our capital and protecting our assets. I'd now like to introduce you to Vince Pezzullo, who will provide you with a more detailed update of the portfolio.
Good afternoon, everyone. I thought today we'd start off with just looking at reporting season and highlighting what we noticed and some of the issues we've discovered during reporting season. And in particular that we're in the latter part of the economic expansion, we need to take care and look for emerging risks which are typically ignored but can be an early warning sign. Currently we have a very tight labour market in the US, and last week US wage growth came in at 3.4%, which is actually the highest in 10 years. Even though bonds have rallied, inflation risk still remains and tends to occur in the latter part of the business cycle. Why is this important? Is that we now more than ever have correlated monetary policy around the world, and what occurs in North America has both a direct and indirect impacts on global markets. US public debt currently, the next point, is at $22 trillion, expanding by approximately $1 trillion in the last 12 months. The concerning aspect of this is it is occurring so late in the cycle when you would expect some rebalancing to occur in government finances. We'll touch on corporate debt levels in the next chart. But there still remains numerous risks around, which will have varying levels of impacts on economies and companies alike, particularly as market expectations are for continued stimulus from China to support growth. But given current market levels, particularly the rebound since December, the market seems to have shrugged off these risks and is looking through them. The question that is to be asked is why the Fed turned its positioning to a more dovish stance in December. We feel that credit markets have spotted weakening global growth, particularly the benefits of the US tax cuts, which will begin to fade as the year progresses, and that liquidity withdrawal was impacting future growth. But I believe this highlights the key risk that remains is the state of corporate balance sheets. We're also seeing synchronised global housing slowdowns in Australia, Canada, UK, Hong Kong and China. This is all based on the pull forward of early stimulus efforts in 2016. And this is starting to wane. And this was financed by global debt build-up to levels not since, we haven't seen these levels since the GFC. When we focus on reporting season domestically though, upgrades were limited in the first half of 2019 in Australia with a lack of visibility and with margins in some industries at cyclical highs. So therefore, there is some limited scope to remove further costs to cushion a slowing revenue line. One interesting feature of the reporting season was a significant increase in inventory levels post the Christmas trading period for domestic retailers. We calculated that number to be at least 26% increase. This could lead to some future margin pressure going forward if the consumer does not step up in the next few months. The upside may be that an expansionary upcoming federal budget may alleviate some of these risks if tax cuts are delivered to bolster domestic spending. Also, given the possibility of a change in government and a possible change in excess franking treatment, we have noticed a step up in companies paying special dividends in an effort to lower their franking balances. Now, if we move to the next slide, we mentioned earlier that one would expect some deleveraging as the cycle matures. Well, what has been occurring, due to the existence of low rates, record low rates, is that companies have been leveraging up as the cycle matures. This chart highlights this fact. It represents the net debt to EBITDA, which is a debt coverage ratio. of the Russell 3000, ex-financials and energy. Historically, this has peaked at approximately 1.5 times and marks the peak of most expansions. And this is where interest rates tend to also peak, because it's interest rates that tends to create the mean reversion. But due to QE, the pricing mechanism, which is interest rates, is not allowing to occur. And we have seen this indicator reach new highs. When you look at the level of BBB debt that's been issued, it now represents, this is the lowest tier of debt, rated debt, it now represents 50% of the market. And we have at least 25% of companies in the Russell 3000 with negative EPS. This typically happens in the middle of a recession, but this is occurring during the latter part of an expansion. This is very concerning as fundamentals are being ignored. This represents a significant risk, and I suspect is one of the reasons there has been a pause at the Fed. As further rate rises, as postulated by this chart, typically could accelerate the mean reversion. As one of the 4 quality filters we use, balance sheet strength is vitally important. This is why focusing on balance sheets is so important at this part of the cycle, and any mean reversion of this chart in particular, there'll be limited places to hide. Now, if we turn to the next slide, we can look at the positive contributors for the first half. Horizon was an opportunistic buy by the PIC as regulatory uncertainty placed pressure on the stock. With a large shareholder selling down, we took advantage of this liquidity event and purchased our stake at around $4. We continue to like the position and feel that the regulatory risks are behind the company and also that some company-led initiatives to improve performance and help drive some earnings growth. We like the management and the balance sheet's in reasonable shape also. Evolution Gold is a domestic gold mining company. We built our position at around $2.79. A preference was for a domestic gold mining company with an ability to expand production, but also has all of its costs in Australian dollars. Still happy with the position. Evolution is a quality-focused management and a near-cash balance sheet. Tabcorp saw improved performance from the lotteries business, with momentum being maintained. While wagering is under some heightened competitive pressure, Tabcorp is matching the competition. We feel this is the right strategy to defend share, as competitors' profitability worsens due to the introduction of the point of consumption tax through most states of Australia and advertising bans are enacted. A newer position was Telstra. We built most of this position below $3. We feel the company has matched its new cost out and digitisation strategy and are right given where Telstra is in its life cycle. This will be a difficult task for the company to execute though. It will take some time for the benefits of the cost out to flow through in the short term, but the benefits of digitisation will be probably felt in the long term. There is some risk though that these long-term benefits are competed away. But we feel that this management strategy now matches the market structure and where the industry's life cycle is. Now moving through the next slide, we can look at what has detracted from performance. Banks and financials have underperformed into the handing down of the final report of the Royal Commission, but also there are broader concerns of slowing domestic economy and its impact on Australian housing. Outside of a broad recession in Australia, the banks represent pockets of value in what is an expensive industrials market, with most embarking on cost-out initiatives to offset slowing balance sheet growth and net interest margin pressure or margin pressure. Our preference still remains Suncorp, CBA and Westpac. Particularly Suncorp, we like the general insurance business. It's a more stable business. It is in what is a duopolistic structure. And given the sale of the life assets, life insurance business, we expect at least a 40-cent capital return, fully franked, in the next month or so. We still do remain underweight the banking sector and financials though. Turning to the next slide, we focus on our 4 quality filters, which has been the hallmark of our investment process for the last 50 years. Point number 1 there, quality business. This is where we assess the quality of the actual underlying industry, try and understand if capital can enter and exit a market quickly, the returns, the level of competitiveness, etc. Conservative debt, this is a hard and fast rule for us. We have an indicator of 50% net debt to equity, or if a number is greater than that, the minimum interest cover, EBIT interest cover, has to be 3 times or greater. Any company that breaches this, we typically kick them out of the quality universe. Sound management, that's where we assess the management's ability to manage in difficult times, not when times are good. see if their strategy is sound, that they are sticking to their strategy to execute on behalf of maximising value for the shareholders. And the final point there, recurring earnings. We don't focus on companies which are themes or concepts. We buy companies that have a history of profit. It is more conservative that way, but typically, as I pointed to in the earlier chat regarding mean reversion of that debt indicator, you need to have earnings to be able to pay back your debt. So we tend to focus on this element, particularly later part of the cycle. I'll move through that at some point later as well. Moving on to the next slide, we talk about one of our larger positions, which we've built over the last 6 months, which is Sonic Healthcare. It's a global pathology business with operations in Australia, UK, Germany, Europe, and North America. It's a very stable business which tends to grow steadily with a key risk of government pricing cuts for the provision of pathology services. This is usually directly felt through the margin. One way that Sonic diversifies that risk is to move up the value chain into anatomical testing. And with that, tries to establish a leadership position in each of its markets in anatomical testing. This typically eventually leads to high volumes through its centralised lab. It relies on more specialist, high technology tests with expert diagnosis from specialist pathologists. Anatomical testing tends to be less exposed to government pricing cuts and therefore protects margins. In December, Sonic announced the acquisition of one of its largest anatomical testing business in North America called Aurora Diagnostics. This now moves Sonic North American business out of testing, which is more exposed to government pricing cuts, and into higher-end pathology testing. We like Sonic for our healthcare exposure, as it's trading on approximately 19.5 times, which is traditionally reasonably what we expect to be an expensive multiple, but it's on a 3.9% dividend yield, but it is actually trading in line with industrials PE, which is about 19 to 20 times. It has a strong balance sheet, and we feel this is a better business than the average industrial in the market today. Now, if we move to the next slide, we'll talk about our experience with one of our biggest positions last year, which was Shire. At one point last year, it represented 12% of the PIC. Now, since our last update, the takeover by Takeda Pharmaceuticals was voted on and approved by both sets of shareholders. Our average entry price into Shire was approximately £33. We exited the position for about approximately £48. We have subsequently started a new position in Takeda Pharmaceuticals in late December at a price of about 4,150 yen. We feel that the market is actually underestimating the potential synergies, and the combined entity is far better business, balanced business, and provides us with a still inexpensive exposure into the bioplasma industry when other market participants like Grifols, which is trading on about 20 times, or CSL, which is trading about 34 times. Takeda is trading on about 9 times PE and pays us about a 4% dividend yield. Now, if we move to the next slide, titled Allocation of Investments, we can see that the current Australian share weighting has increased to about 78%, with global falling to approximately 2% at this stage, with Takeda representing the bulk of our investment in offshore markets, and cash representing the balance as at 31st of January. If we now move to slide titled Performance, we are disappointed with the performance over the last quarter, as a minimal exposure to resources and having a higher than average cash weight has hurt as the market has rebounded. My preference, given the lateness of the cycle though, is that some of the other risks that I've highlighted earlier regarding corporate leverage ratios, which are well above the last 3 cycle peaks dating back to 1980, is that we should focus on balance sheets and avoiding businesses with high operating leverage and high financial leverage. This should protect the portfolio from risks we cannot anticipate.
Okay. Thank you, David and Vince, for that update. We will now open up for questions. So just before we do that, thank you to those who pre-submitted questions upon registration. We'll certainly attempt to get through all of those on today's call. And just a reminder, if you've logged in via the webcast, please click on the Ask a Question tab on the top right-hand corner of your screen and submit your question. Alternatively, for those on the line today, if you wish to ask a question, just simply press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, should it be covered throughout the call, just hit star 2. and we just encourage, if you're on a speakerphone, just to use your handset so it's just a bit clearer. All right, so let's kick off. First question we're going to cover today is from John Castell, and this was a theme. We had a few questions come through around people interested in franking credits, and in particular the outlook going forward, given Labor's decision. So I might throw that one over to David to answer.
Yep, thank you. And this is something which the board has been actively thinking about, as has Vince, in terms of how he manages the portfolio. And Vince has been strategically managing the portfolio to protect franking credits for investors. But in anticipation of potential legislative change, the board is actively considering its response to facilitate investors receiving the benefits of accumulated franking credits. And we'll keep you posted on that.
Okay, thanks, David. We had a question also coming from Ian Meller. Ian was keen to understand from Vince around the reduced weighting to overseas shares in the last 6 months, and as well his thoughts moving forward.
Okay, thanks, Jason. So if we walk back to mid last year, I mentioned earlier, obviously on the presentation, that in the PIC, Shire was about 12% of the portfolio, was a fairly large exposure for our global, of which we can go up to 25% in total. We did have a few other smaller positions, but we took advantage, obviously, of once the takeover had occurred, and we sold out of our entire position. That vastly reduced our position. And we sold out of a few other positions in November as well. Look, the way I typically look at our global exposures is we tend to be opportunistic, looking for businesses which are trading well below fundamental value. It takes time. You've got to be patient as well. We don't want to just, we're not looking for just pure beta. We're looking for an ability to add value to the investment. And that, at the moment, as I mentioned earlier, we are a little bit concerned of where the market's rebounded to pretty aggressively. US reporting season wasn't particularly good either, as well as the Australian reporting season, and the market multiples actually expanded in the last 3 months. So for us, we'd rather be a little bit more conservative, as I said earlier, just be a little bit more conservative and just wait for the opportunities and be opportunistic. We've done that in the past before with Deutsche Börse post the US elections. We took a fairly large position there, and we're looking for new opportunities. We will flex that global positioning up to 25% pretty actively. Okay.
Thanks, Vince. David, just a question from you came through from Anthony, and he was just interested in the share price, just the current state of the share price.
Yep, thanks. Since listing at 97 cents in December 2014, the share price has been steadily growing, peaking in July 2018 at $1.21. As at the 11th of March, PIC share price was 105, and its pre-tax NTA was 1.117, and after-tax NTA of 1.111, and both of those are cum dividend. The dividend yield for the company has also been strong, delivering 17.4 cents since inception. While PIC is currently trading at a discount to NTA, the share price has shown an upward trajectory, and we're actively providing information to investors via email, the monthly report, newsletter, and via the PIC website. And I think when you look at that, the things that tend to drive trading at a discount or a premium tends to be investment performance, a strong and dividend stream, which we certainly have provided, shareholder engagement like today's call, and also size, so that you have the appropriate scale. And we think that the capital raising we did at the end of last year has added to the scale. So we are focusing on that.
Right, thanks, David. Peter had a question just around agriculture. Peter's question was, agriculture does not seem to feature much in the portfolio. Is there a reason for this? I might throw that to Vince.
Thanks, Jason. We actually do have a few positions which are exposed to agriculture, both directly and indirectly. We own Bega Cheese, which is a milk processor and sells upstream products as well. That represents about 2% and a bit of the portfolio. We also have a position in Select Harvest, which is a domestic almond growing business, very low cost operator. We like the management and their prospects, and in particular, given water restrictions in California, which is the largest almond market. We quite like the cost base of Select, and that's, again, a further exposure to agriculture. We also have an exposure to IPL, Incitec Pivot. It's actually the fertiliser producer, as well as an ammonium nitrate producer, so explosives to the mining industry. So again, that gives us indirect exposure at the moment. IPL is approximately 2.5% of the portfolio. So I think we've got about 6% of the PIC is invested in agriculture at this point.
Great. Thanks, Vince. Look, we had a few questions come through of a similar nature, one from Manfredo. Just to, I guess, getting your take, Vince, on, where is the Australian economy at, and, are we headed towards a recession? Vince, I'll throw that one to you.
I'm not going to join the club of most people that try to predict recessions, because I think anyone can pick them. So what we tend to focus on is going to work backwards from what the market's telling us. So the market's rebounded pretty strongly, so we're going to be a bit careful about, as I said before, being exposed too heavily to companies with excessive operating leverage. And if you've got a lot of financial leverage as well, any sort of changes or slight slowdowns in Australia might have an impact. We might get a budget, as I said earlier, we might get a budget that sort of stimulates the economy in the short term, but whether consumers come to the party and spend any sort of windfall gain from government handouts, I'm not too sure. The best way to protect yourself is let the valuations tell you whether the market's pricing in a recession or not. I suspect the market is not pricing in any sort of slowdown at this point, so we'll take the advantage of it. It's clear that things are slowing in certain parts of the economy, but I think given our exposures, we're reasonably conservative in our positioning in the likelihood, or if there's a subtle slowdown in Australia, if it turns into something bigger, I guess the biggest exposures, the impacts will be in housing. Obviously, it's already started with the cycle there, but we don't really have any direct Australian housing exposure. And the banks is the second order impact, obviously. But the banks are reasonably well capitalised, but if the recession hits, it's sort of every man for himself, so to speak. So our position, I think, is we've got low exposure to that sort of, if that occurs or eventuates, and we're carrying quite a bit of cash at the moment. So any sort of, when the market starts to decide to price that sort of risk in, we'll have an ability to take advantage of any opportunities to invest in that.
Thanks, Vince. Look, we just had a question via the webinar from Anthony. Vince, you touched on investment performance in the presentation. Did you want to add anything to that, Anthony? His question was around the sort of more short-term performance, and what are some of the catalysts for change and things that we're looking at when it comes to that? Yeah,
the performance, in particular, it's most of the damage to the portfolio has been in the last quarter. In that we had a couple of positions. The two worst contributors have been Clydesdale Bank, which has fallen about 40-odd%, and Fletcher Building, actually, the two positions. Now, Clydesdale, we were exiting that position, but it sort of got ahead of us, and it cost us about 1%, actually, in performance. But Fletcher Building, we've actually been buying more as it's rolled off. We still see a lot of value. If you think about the positioning of the portfolio, as I said, we are conservatively positioned in a market that's put on 10 to 12% pretty quickly. Okay, and in that environment, we will lag in that sort of a market at this point, given where we're positioned. We are sort of positioned for a bit of a volatile period. If you went back 6 months ago, the performance we were materially ahead of market. So that's how quickly it's turning at the moment. So all I can say is that we are, as a quality and value manager, we are sort of preparing for the worst, hoping for the best, but preparing for the worst. And that's how we're sort of positioned. And I think as we move through the year, you'll start to see evidence that the portfolio will hold up reasonably well in that sort of a volatile environment.
Okay, thanks, Vince. Just had another question from Anthony, just around, perhaps for you, David, around any plans to raise further funds in the immediate future.
Yeah, on the back of last year's capital raise, I think at this point we don't have any immediate plans to raise additional funds. We were able last year to take advantage of some market softness after the fundraise to make some investments, and again, I think the additional liquidity is helpful over a period of time for existing investors, and we'll keep you posted, as our thoughts evolve on that.
Look, you've got to also take into account that it is a point in time when doing the raising. Yet we are trading below NTA today, but it is an equity exposure. You are exposed to markets when you buy an LIC. I think you've got to think of it also as it's the total return. Think about the dividend as well, not just the movement in the share price. In that we've paid about 17 cents, and it's actually fully franked. That component, that's, I've done the numbers. It works out to be almost a compound 10% return since listing. So that's what we sort of shoot for as an equity investor, and I think we've got a lot of it through our dividend profile and our dividend payments. So as Perpetual, we typically have reasonably high distributions because of our style, and I think you should expect that to continue.
Great. All right. Well, look, there's no further questions at this time. So thank you for all those that did submit questions previously. I hope they were all covered. If not, feel free to reach out to us and we can respond. Well, actually, we've just had a question come through over the phone from Kate, so we might just quickly take that before we close while she's got the opportunity.
Okay, thank you. Just a question on banks, and you'd have to say that the risk of a downgrade to earnings is on the cards for them, so I can't quite understand why you're holding them, because that will alter the PE to the market, and they've got significant challenges from the credit cycle changing, with the biggest credit cycle, easy liquidity we've ever seen, and low interest rates, and consumer spending showing us that people are having problems meeting their living needs. So over to you on that.
So you got to think of it also in what you're paying today for the banks. So the markets, as I said, they've underperformed quite a bit. So the market has been pricing in the eventuality of a slowdown into the banks, and that there is, I agree, there is slowing credit growth, but the banks are reflecting that in the multiple you're paying today for them. They're trading on between 1.2 and 1.7 times price to book as well. They are generating still excess capital at this point because they are doing between 11 and 13%, 14% ROE, so they are generating excess capital. As you rightly pointed out, if there is a credit cycle, they do wear a bit of it. But I think the market's pricing elements of that already because they've underperformed by about 30% over the last 12 months, the banks. They've really been left behind. So if, as we go forward, this is an actively managed portfolio. We do tend to assess risk on a daily basis. We do move pretty quickly. We don't own any ANZ and NAB. We own CBA, which I think is one of the highest quality banks, given its deposit franchise. They're carrying a lot of capital, the banks. So the biggest risk with banks has always been, while the volatility of earnings, I agree, is always a risk, the biggest risk is that banks have to do dilutive capital raisings at the bottom of the cycle. And I suspect now that with Tier 1 ratios at 10 to 11%, which is probably 2 to 3 times where they were pre-GFC, that risk of a deeply discounted rights issue at very low prices is very low. So that's always where our biggest risk remains.
Okay, thanks, Vince.
Thank you.
Okay, I might have jumped the gun there or scared people into asking a few more questions. So just got a question here from Jeff that's come through. Jeff's question is, how do you see lost franking affecting markets? I guess a sell-off in stocks with low growth, higher income profile, and the viability of PIC given trades below NTA currently?
Look, it's the loss of excess franking credits, not loss of all franking credits. So there's got to be an important distinction made there. I suspect there's one element of the investor class, SMSF investors that do benefit from the excess. I agree it is a risk for them. Whether there's a step up in, or people start focusing more on unfranked, the SMSF investors focus on more on unfranked dividends. So just going for pure income, the REITs or the trusts of some sort is where you can get that income. But I think the market's been sort of quietly dealing with that over the last 6 months as we roll into an election cycle. So whether there's a difference of the type of, I don't think it changes the way companies invest and or their dividend plans. If they're sitting on excess franking credits, they've been sitting on them for long enough, they should have got rid of them by now. We've still got a couple more months. We might see a few more special dividends as well to clear those franking credits out. But I don't think it's going to change that much, personally. And what was the second part of the question? Sorry, just missed it. Viability of PIC trade. Well, it's below NTA. Markets are quite weak. Unfortunately, with the listed structure, you will get moments where we will trade at a discount, which we're trading at a premium 9 months ago, 6 to 9 months ago. So it does go from one extreme to the other at times. Hopefully, the fact that we do pay a pretty steady dividend stream at these levels, if we pay another 3 cents in the second half, if we do pay that 3 cents in the second half, you're on about a 5.5% fully franked dividend yield here. So, and we've built a buffer on our franking credit balance as well, so we can maintain that going forward. So I'm assuming that as people look for value, they'll see that that dividend yield is pretty robust, and that at some point that'll close that gap.
Great. All right, thanks Vince, thanks David. There appears to be no more questions. So thanks everyone for dialing in today. This concludes our update. You may now disconnect. Thank you.